AT&T is a global telecommunications and media company. The company provides a wide range of telecommunication services, including wireless connection and data services, internet connectivity, and television services. As we can see, the stock has been absolutely beaten up this year, with the stock being almost down 20% year to date, and it's looking even worse on the longer time frame. If you had invested $1,000 in AT&T 5 years ago, you would have seen your investments decline to a value of only $590 today. However, this is without dividends, and dividends are a big part of the appeal to investors as they pay out a significant yield that's currently sitting at over 7%. Let's move over to our QuantView Stock Insight tool to get a more broad insight into how AT&T is performing. As we can see here, the revenue of AT&T has been on the decline in the recent years. This is a recurring trend we can see in the EBITDA and free cash flow as well. The net income has been very inconsistent as well, with them posting losses in 2020 and 2022. Something we can also see with similar companies to AT&T are the enormous debt positions these companies have. In 2022, AT&T had a debt position of $240 billion and only a cash position of $3.7 billion. This is something we'll look into a bit more in the next segment of today's video. But moving on, the dividend has also been cut in 2021 as part of the spin-off of AT&T did with Warner Bros., ending a pretty decent history of dividend increases. And by the way, if you want to get access to the Stock Insight tool and all of the valuation models that we'll be using in this video, be sure to check out my Patreon link in the description, where you can get your hands on a bunch of spreadsheets to enhance your investing journey. And with that out of the way, into this video, we'll be taking a 3-step approach to thoroughly evaluate AT&T and determine its fair value. Step 1. Margin of safety. In this step, we'll look at AT&T's key metrics and ratios to determine if we should be more or less cautious when determining a fair value. Here, we'll delve into AT&T's financial statements and assess critical metrics and ratios. In step 3, we will be using a combination of valuation models such as discounted cash flow and discounted dividend to gain insight into the value of AT&T's business. By using these models, we can determine whether the stock is currently overvalued or undervalued in the current market based on different metrics. In conclusion, by combining the findings from the 3 steps, we'll ultimately determine the fair value of AT&T as an investment opportunity. To determine this final valuation of the stock, we'll be using a margin of safety. This margin of safety will be based on the financial ratios, the financial health, and the growth of the company. We'll be using a standard margin of safety of 25% that can never go below 0%. The margin of safety can either increase or decrease based on the ratios that we're going to be looking at in just a moment. And the severity that the margin of safety will increase or decrease by will be determined by using a scale. When we are using 4 colors in our scale, bright red will mean a 5% increase, orange will mean no change, light green mean a 5% deduction, and bright green mean a 10% deduction from a margin of safety. When we're using 3 colors, bright red will mean a 5% increase, orange will mean no change, and bright green mean a 5% deduction. The first metrics that we'll be looking at are the margin and EBIT growth. As we can see, the EBIT has gone up over the years, going from just over $15 billion in 2014 to just under $30 billion in 2022. The average EBIT growth during this period has been sitting at 12%, which is in the light green part of our scale, indicating a 5% deduction in a margin of safety. If we look at the margin, it has also gone up significantly over the years, going from 11% in 2014 to 24% in 2022. The average margin growth during this period has been sitting at 13%, which is way past the bright green part of our scale, indicating another 5% deduction in the margin of safety. Moving on to the next metrics, we'll be looking at the dividend growth and the payout ratio. The dividends have gone down, of course, over the years, as we have seen in the previous segment of this video, going from $1.80 a share in 2014 to $1.12 a share in 2023. This gives them a dividend growth rate, well, in this case, negative dividend growth rate of 3.5%, which is in the red part of our scale, indicating a 5% increase in the margin of safety. If we look at the payout ratio the dividend is supported by, it's currently sitting at 44%, which is in the orange part of our scale, indicating no change in the margin of safety on this metric. If we head over to the final metrics we will be using in this video, these are the debt to EBITDA and return on invested capital. To get a debt to EBITDA ratio, we have to take the debt of the company, subtract the cash from it, and divide it by the EBITDA. Out of this, we get the amount of years of EBITDA it takes for the company to pay off all of their debt. For AT&T, this is very large, in this case 3.5 years, which is a 347% debt to EBITDA ratio, which is in the red part of our scale, indicating another 5% increase in the margin of safety. Return on invested capital for AT&T is currently sitting at 11.5%, just missing out on the 5% deduction in the margin of safety. So, in this case, no change in the margin of safety on this metric. Let's go look at the valuation models next to determine the intrinsic value of AT&T. The first valuation model that we'll be using is the discounted cash flow model. I've imported the free cash flow of AT&T going from 2014 to 2022. The average growth rate and the annual free cash flow during this period has been sitting at 9.4%, and I'm projecting their future free cash flow to grow by 4% annually for the next 10 years. With this percentage, we'll determine the future free cash flow for AT&T and determine a terminal year of valuation, using a perpetual growth rate of 3% and a discount rate of 9%. This leaves them with a sum of free cash flow of $283 billion, and to get to our equity value, we have to add the cash and equivalents and subtract the debt. And that gives us a equity value of $132.1 billion. And dividing this by the amount of shares outstanding, we get a discounted cash flow price per share of $18.48, which is an upside of over 23%. The second model that we'll be using is the dividend discount model. I've imported dividend payouts of AT&T going from 2019 to 2023. The average growth rate is of course negative due to the spin-off, sitting at negative almost 11%. And I'm projecting all of their future dividends to grow by 3%. And we'll once again be using the discount rate of 9% in this valuation, leaving us with a dividend discount model price per share of $19.06, which is an upside of almost 27%. The next model that we'll be using is Graham's revised valuation formula. In this model, we'll be looking at the forward EPS of AT&T. We'll be looking at the growth rate estimate projected by Wall Street and the current yield of AAA corporate bonds in relation to the average yield of AAA corporate bonds that is always sitting at 4.4. And we go by the theory of Benjamin Graham that the PE of a company with no growth should never exceed 7. And looking at all of these metrics, we get a Graham's price per share of this model of $18.73 a share, which is an upside of almost 25% from the current price. The fourth model that we'll be using is the multiple valuation. In this model, we'll take a look at similar companies to AT&T, look at their stock price, and determine their forward PE multiple. This is to determine the average PE multiple in the industry, which in this case is sitting at just over 8. And all it's left to do to get our price per share of this model is to then multiply by the earnings per share that AT&T is expected to generate in the future. And this gives us a multiple valuation price per share of $19.85 a share, which is an upside of over 32% from the current price. And the last model that we'll be using is the mean reversion theory. In the mean reversion theory, we go by the theory that a company will always trade above or below its mean, and the metrics that we use to determine this are the dividend yield and the PE ratio. In this case, I've imported the dividend yield of the past 5 years, and on average it has been sitting at 6.68%, while the current yield is sitting at 7.34%, indicating that it's undervalued on this metric. Doing the same with the PE ratio, on average it has been sitting at 8.70, while the current PE ratio, or at least the forward PE ratio, is sitting at 6.45, indicating that it's once again undervalued on this metric. This gives us a price per share out of this model of $18.38 a share, which is an upside of almost 22.5%. Let's go look at the final overview of our valuation next. Looking at our final overview, we've imported discounted cash flow, discounted dividend, Graham's valuation, the multiple valuation, and the mean reversion theory price per share, giving us an average of $18.90. A margin of safety we've determined earlier, using a standard margin of safety of 25%, deducting it by 5% for the EBIT growth and 5% for the margin growth, and 5% added for the dividend growth, and another 5% added for the debt to EBITDA, leaving us with the same 25% margin of safety that we started with. Applying this margin of safety, we get a fair value of $15.12, and with the current price of $15.01, we get an upside of almost 1%, indicating that it's trading very close to fair value currently. And that of course then indicates a slight buy rating per our valuation. Now, if you want to get access to all of the valuation models that I used in my videos, and of course also the quant view model, you can check in the description for my Patreon link. This would support me a lot. And if there's any other companies that you would like to see me cover in my videos, please let me know in the comments. Thanks for watching.